Olivia saved exactly what the rule told her to save: 3 months of essential expenses. 11 weeks later, nearly all of it was gone to years, and she still had no replacement income. The mistake was not that she failed to save. She saved for the wrong emergency. The biggest emergency fund mistake is not always saving too little. It is choosing a number before defining the risk that number is supposed to protect you from. Because this money has two different jobs: keep your life running when income stops,
and survive one urgent financial hit without destroying that runway. By the end of this video,
you will know Olivia's real target tried and how to calculate yours with 4 answers instead of 1 generic month count. 3 months is not bad advice. It is incomplete advice. A household with 2 stable incomes does not face the same risk as a freelancer who depends on 1 major client.
a worker who can replace a job quickly does not face the same recovery time as someone in a specialized field.
They may spend the same amount each month, but they do not need the same amount of protection. The number of months should come after the risk assessment, hers not before it. Olivia needed 4 answers, not 1 copied number. I call it the risk test: required monthly costs, income recovery time, shock buffer, and keeping true expenses separate. Those 4 answers turn a generic rule into a plan built for a real life. Olivia's normal spending was almost $4,400 a month. But an emergency fund does not automatically need to preserve every part of a normal month. She removed restaurant meals, shopping, subscriptions, travel savings, investments, and extra debt payments that could temporarily pause. Then she kept housing, basic utilities, groceries, insurance, minimum debt payments, necessary transportation, medication, and essential family obligations. Her required monthly cost was $3,950. That was the life the fund had to keep running. Next came the question most rules skip. If Olivia's income disappeared today, how long would it realistically take to replace it?
Not in the best month. Not during a perfect economy. Realistically, her income varied.
One client represented a large share of it. Replacing that client could take months. And no employer was providing predictable severance or paid leave. But she had no dependents, manageable insurance exposure, and family nearby for a serious crisis. 3 months felt optimistic. 6 months felt more conservative than her situation required. 4 months matched her actual recovery risk. At this point, Olivia thought she had found the answer. She had not. One missing layer could still erase almost half a month of runway in a single afternoon. During Olivia's income gap, her essential car needed a $1,300 repair. If that repair came directly from the income runway, it would immediately shorten the time she had to find good replacement work. The shrinking balance was not only paying bills, it was beginning to decide which clients she could afford to reject. So Olivia added a separate shock layer casual. It enough to absorb one urgent, realistic cost that could not wait for normal cash flow.
Based on her car, health coverage, and most likely urgent expenses, she chose $1,500.
Olivia's risk-based emergency fund target was $14,100. Her old target was $9,450. The difference was not a punishment for choosing 3 months. It was the price of matching the fund to her actual recovery time and the urgent shock it needed to survive.
She had saved toward a number that answered someone else's question. Subscribe to Daniel Smart Finance, where every paycheck gets a job before life gives it one. This series is building one complete money system, a pie, from payday to emergency savings to the first $10,000.
But even the correct target can fail when the wrong expenses keep rating it. Olivia had been calling almost every irregular cost an emergency: new tires, routine dental work, registration renewals, annual premiums.
A laptop that was already 5 years old. They did not happen every month, but that did not make them unpredictable. They were true expenses, tructure, predictable categories with inconvenient dates.
Olivia totaled the predictable costs from the previous year and converted them into one monthly transfer.
Now routine costs had their own bucket. They no longer shortened her income runway or consumed her shock buffer. Before using the emergency account, Olivia asked 3 questions. Is it necessary? Is it unplanned?
And does it require action before normal cash flow can cover it? A medical bill not covered by insurance may qualify. An essential car repair needed to keep working may qualify. Temporary income replacement may qualify. A discounted vacation does not. A planned phone upgrade does not. And maintenance does not become an emergency simply because it was ignored. The rules did not make Olivia afraid to use the money. They protected the fund from convenient excuses. Emergency money has a boring job. Stay safe, stay accessible, and stay away from everyday spending. Olivia did not invest this money in assets that could fall when she needed it. She also did not leave it inside the checking balance she saw before every purchase. She kept it in a separate insured savings account with no debit card attached.
The account did not need to be exciting. It needed to be there.
$14,100 can feel impossible when someone is starting from zero. So Olivia did not treat the final target as the first step. Her first milestone was $1,000 pads.
Enough to stop many smaller shocks from becoming immediate credit card debt. Her second milestone was 1 month of required expenses, $3,150. Her third milestone was the complete $14,100 target. These were not 3 amounts added together. They were 3 milestones inside the same target. Financial safety began the first time an unexpected bill did not create new debt. You can build a more honest starting target today. First, calculate 1 month of required expenses. Remove anything that could pause during a genuine income emergency. Second, estimate your realistic income recovery time using job stability, household income, dependents, benefits, and how long similar work usually takes to replace. Third, and choose one reasonable shock buffer based on the urgent costs most relevant to your life. Then keep predictable true expenses in a separate monthly bucket. You do not need the perfect number tonight. You need a number that describes your risk better than 3 months, because everyone says 3 months. Your emergency fund is not just a number of months. It is the amount of time and choice you can buy when income stops. Olivia's mistake was copying the number before understanding the risk. Describe your income with 1 word: stable, variable, or uncertain. Write it below. But even the right emergency fund can fail when your brain keeps finding reasons to rate it. Subscribe. That is the mistake we solve next.